Now we want to welcome in Ginny Horne, host of NextGen and markets correspondent, to help set up the trading day. All right, Ginny, we know you're across some major movers, but I want to get your quick take on the market action, given the wild ride that we had yesterday. Because, you know, my day usually finishes earlier because of when I start. And when I checked on where markets closed, I was like, what? What happened? All right, take us through your kind of take on where things stand.
Okay, I will say, Dan, I had these very similar thoughts because by 2 p.m. here in Chicagoland yesterday, when they were starting market on close, we were calling it a turnaround. And I was like, well, hold on, it is not a turnaround until we actually see the indices higher. And I was sort of joking that we were still a ways away. And then within about 10, 15 minutes, we saw, a pretty substantial flip of price really in the latter half of the afternoon. And so, of course, following some commentary from Trump, but obviously we know the president to speak in pretty broad strokes. So I would say markets definitely gave that some weight, no doubt about it. But it does still seem like right now oil, continuing to extend its recent slide, as right now some of the commentary on the Iranian war seemingly is improving. Of course, those exact words he used were very soon. We could see an end in sight. And so oil plunged as much as 10% before paring back some of those losses, as again, we digested some of the risk on versus risk off trade. I think it's been really interesting to see the names that have performed well outside of anything with energy exposure, like any of the energy equities, because we've seen still really nice resiliency from the telecoms or certain pockets of tech. A huge portion of the recovery yesterday was really driven by names like Micron, for example, which has been, such a resilient name in broader tech. So I think it's been interesting to see what's working in AI, what's working in the broader equities that are not just tech focused. And seemingly it's been anything with staples and telecom exposure, which I guess you'd expect, but it hasn't felt as maybe even as perhaps other periods. And I will say that I think it's also really interesting to see the way that some of these oil supply chain fears could factor into some of these big tech names. I do tend to watch tech first and foremost every morning, and we are actually poised for at least a decent open here with participation from the Mag 7 outside of at least Microsoft.
Okay, let's talk about the latest with HPE. They put out their quarterly numbers after the bell yesterday. Guidance looks better than expected. Take us through some of your takeaways here.
Yeah, I have to say I was fairly surprised that I've seen some more muted analyst activity on this name in reaction to this report. That was, a lot to like here. I guess that has been the theme of earnings, trying to figure out what the market is deciphering as good, what the market is deciphering as bad. HPE did overall deliver, though, a solid earnings beat with adjusted earnings per share that did top expectations pretty handily. Well, we saw also better profitability and cost control than the market had been anticipating. Revenue rose 18% year over year. That's also signaled some improving demand across enterprise infrastructure despite this very mixed IT enterprise spending environment. And networking was a standout strength. We did see networking surging more than 150% year over year, driven by strong campus data center networking as well as security demand, plus some early benefits of that Juniper integration. Margins also improved sharply, with non-GAAP gross margin rising more than 700 basis points year over year, reflecting again some product mix improvement and pricing discipline, frankly, as well as better supply chain execution overall. Now, to flip the other side of the coin, revenue did come in slightly below expectations, missing estimates by a small margin, but still a headline miss. And despite the earnings beat, we again are seeing more of a negative reaction this morning, suggesting that investors may be more concerned about some of the pricing pressures due to the chip shortage right now that's facing a lot of scrutiny overall. Just anything with right now tech exposure could obviously be victim to that. And so management did acknowledge some ongoing commodity cost inflation as well as supply chain volatility. And overall full year guidance was solid, but not meaningfully raised on revenue, which could temper some of the overall enthusiasm of this, again, enterprise IT spending environment. But again, I don't know if we could say that necessarily memory and these high memory costs are to blame, because I did see one analyst note that said that's still a major headwind. I think right now, anything that is exposed to a growth narrative or, just an overall volatility play is seeing a bit of caution just because of the uncertainties tied to the overall market.
All right, and let's talk Taiwan Semi. It's out with its monthly numbers. We know we get a kind of regular cadence with those figures. Take us through the numbers.
Okay, and Taiwan Semi has also been a really interesting part of the tech story, of course, this year, as it's the biggest foundry business really in the world. And so right now, we're seeing a report of 22% year-over-year revenue growth in February, despite nearly a 20.8% monthly decline that we saw, I mean, pretty consistently. And so as far as some of its numbers have been, I mean, this has been extremely strong as far as its growth story. And again, their manufacturing January revenue continues to rise another 30%. And this is an enormous company. And obviously, we know that they continue to thrive as we see more and more increased need for AI hardware, but also software as well. So, I mean, again, February sales rising 22%. This was a slowdown from the 36.8% year-over-year growth we did see back in January. But the growth rate appeared skewed because of, first of all, the Lunar New Year falling in January of 2025, which shifted some of the comparison basis just for February and made the year-over-year increase in February then appear less representative. And so also, we did see some alignment to, I mean, like other major tech companies. I mean, this name has its hand in everything to Alphabet, Amazon, NVIDIA. And so this is a huge component of obviously the broader AI infrastructure build, which is also why I think it is definitely worth noting. I know this is not necessarily tied to the sales figures we got today, but while this is not a direct beneficiary or direct benefit or dependent on the Strait of Hormuz for their chip shipments, they are indirectly exposed because of what we know as the LNG imports, which do come from Qatar, but also to ship mostly entirely through the Strait of Hormuz, which is then, of course, being run down the supply chain to Taiwan Semiconductor. So it's very important that we continue to see them navigate this very difficult supply chain as masterfully as they have, frankly, because, again, they have their hand in so many of the building components of every major tech company, every major technology that we've seen really emerge in the last several years. So this is an important one, but I will say it's double-digit growth. I mean, it's almost like we're being very critical of these names at this point, Diane.
Okay, and let's switch gears and talk Kohl's off the back of its quarterly results. I'm seeing shares under pressure. It looks like it was a mixed bag here.
And I do feel like a very mixed bag has been a great way to describe a lot of the trends we've seen in like broader department stores and things, frankly, that are not like a Ross Stores, TJX, with more of that price really, I'd say, divergent from just, being low in cost and affordable. So Kohl's also has been a bit of a meme stock play because, I mean, it's carried relatively high short interest for quite some time. So it's volatile, and that does not always mean to the downside, of course, like we're seeing today. But I will say that there is that added degree of volatility to this name just because, again, the percentage of its overall float that is sold short. Now, they did see earnings per share that did come in above analyst estimates, as well as we did see net sales, though, declining about 4% from last year. And that also came in below the street's expectations. And so comparable sales dropped 2.8%. That was compared to the 1.5% drop the street had been expecting. And Kohl's stock has slid as much as 8% this morning before actually recovering ever so slightly here, with shares already having, actually really taken it on the chin this year. We're down about 31% so far in 2026, and a name that's actually still amazingly up about 21% over just the last 52 weeks. And so it's been, again, this turnaround story for a name like Kohl's, where we've seen this real turnaround effort from the company. And we did see, some metrics improving, like we did see that their CEO did highlight the fact that they have made meaningful progress. But again, revenue did not illustrate that. And they did say that they're seeing some repositioning in their department stores and they're scaling back some of their not performing categories. But all in all, they're firmly committed to this strengthening of their foundation. But I do think the numbers speak for themselves. And if you have great commentary, you need numbers to, of course, then back the turnaround story.
All right. Thank you, Jenny. Great deep dive there. That is Jenny Horne, co-host of Next Gen. You can catch Next Gen and Jenny and Alex later today at 1 p.m. Eastern.